No, was it you got mail? Was it Yahoo or something? AOL? Was it AOL?
You
Yeah,
got
well,
mail.
you
That
got
was like
mail.
that was the movie. But I mean, we used to bring the newspaper to the internet. Like I used to sit with my father and read the Journal or the Times or something while we were waiting for stuff to dial up and connect. It's pretty funny. But long story short, we've seen some bogging down lately, and it's kind of like when all the kids come home from school and all of the everyone goes on and plays their games and stuff, it bogs it down. Now we've got everyone data centering and using, what's the race to use tokens or whatever. I don't know. Anyway, I digress.
Well, we're live and we're getting ready to start. We've got a couple minutes, I believe.
All right. Where you guys? You guys nice and hot down there like we have up here in New York?
Yeah, I was just telling John, I think it was 95 today outside right now.
You know, growing up in the 70s, it was hot in July. About as hot as it is right now. I don't know. Feels like it always did.
John's making us jealous out there in San Fran, though.
58, Jeff.
I gotta get my wetsuit. I'd probably need a 5'3" out there.
You know, those are
5'4", excuse me.
those are the surfers. They're out there in the 55-degree water in their wetsuits,
Booties, 8 mil booties.
dressed up to look just like a seal.
Yeah.
I don't think I could fit in one of those.
Oh, they make them big.
I'll go on GLPs for a month or two, and then I think I can make it work.
You know, a wedding,
I got a better program for you, Mike. Yeah. July markets. Been interesting. Trump cycle still in play. You guys watching that? The old taco trade.
Well, you did nail that first quarter, talking about the whole buying into the Trump volatility, but are we going to get a sequel? Yeah, I don't want to give it all away. I got to wait a minute or two for the rest of the people to filter in before we give all the good stuff away.
Let me close my door. Still tracking, Mike. I'm updating the NASDAQ version right now.
All right.
All right, we can get started. Welcome, everyone, and thank you for joining us today for our Money Shows virtual event, Investing in Alternatives. We're excited to have you with us, and our next session is our Top Stocks for the Rest of 2026 panel. Moderating this panel, we have our Editor-in-Chief, Mike Larson. I'm going to pass it over to you now, Mike.
Great. Thanks, Madison. Welcome, everybody. We're at the tail end of this virtual expo. And as you can see, we're trying to give you some extra value. We're already chatting about the market before we even officially start. So if you're an early bird, congratulations. I hope you've really enjoyed this event. We've had a lot of great speakers kind of summarizing what they're seeing in the markets, both public and private markets, as well as focusing on some of the alternative investment strategies you can use in this. I guess I would call it an increasingly volatile market. We'll have to see what happens these next few weeks, but we had the craziness at the beginning of the year, things calmed down, and now as we're rolling into the second half and the second quarter earnings season, we're going to see what kind of fireworks we get out of that. But I want to go ahead and get straight to the panel since we only have a half an hour. You may be familiar with one or more of the gentlemen you're going to hear from here, but just in case you haven't seen them speak either online or at one of our events, we've got Jeff Hirsch, editor-in-chief of the Stock Traders Almanac and publisher of Almanac Investor. He's also the author of multiple best-selling books. Jeff's been working on Wall Street in one form or another for more than 35 years here. You've probably seen him on CNBC, Bloomberg, Fox Business, and just so everyone knows, his Stock Traders Almanac is now in the 60th year of publication. Is that correct?
The 27 edition will be the 60th.
Okay, so we're right. We're coming up.
Guess who else turned 60?
Let's see. It's not me. I can at least let that much be shared. Well, congratulations. That's a great long-term track record there. John McCammon actually joined the leading investment newsletter in his sector, the biotech sector, called Medical Technology Stock Letter, as associate editor in 1987, was named editor in August 2000. He too has been spending more than 35 years on the front lines of biotech investing. John, when did that letter start? I know we're not at 60 years yet, but what was the very first year of publication?
Looking at 1983, and I believe that was a Genentech IPO year.
Oh, wow. There you go. There's a name from the past. Excellent. Well, welcome, John.
Thank you.
Luke Lloyd, founder and CEO of Lloyd Financial Group. Luke's firm emphasizes client-first decision-making, clear communication of performance, and readily accessible financial guidance. You've also seen him on Fox Business and other financial media. Luke, welcome.
Glad to be here. Let's rock and roll.
Yeah, apparently Luke hasn't heard of what was it, the AOL dial-up days,
AOL.
but
I mean, I think I was 3 years old, when that stuff was happening. I remember I was over at my buddy's house. I think we were playing the Nintendo 64 or something, and we had to shut it off because someone had to get on the phone call or something. Yeah, I was
man.
like 4 years old, but I do remember faintly those days.
You had it tough, my friend. Let's leave it at that. But anyway, guys, thanks so much. I do want to get right to it. I'd love to keep chatting, but we have listeners that have their pens and pencils ready. So let's talk stocks. In this market, again, we've rebounded quite a bit. We have some questions about whether we're going to be back in this sort of Middle East turmoil, whatever you want to call it. Oil prices, of course, are down quite a bbit from their peak regardless. We've seen some broadening out in the stock market. Some great commentary I was reading the other day on the performance of small caps relative to the large caps, and also the equal weight S&P relative to the overall S&P. It's doing pretty well. So I guess, Jeff, let me start with you, just in case somebody missed some of your commentary recently on what's going on in the markets. Just set the stage, what you're seeing, and maybe what looks attractive to you. We'll start with the first name, sector, or stock.
Little stage set where we're entering the worst 4 months of the year, July through October. We're waiting on a MACD seasonal sell signal for NASDAQ right now. Looks like it's going to turn positive, which it has to do before it goes negative. So we're looking at that mid-year rally, what I call Christmas in July. Started out like gangbusters last few days of June, paused a little bit. We've had some news coming out of the Gulf, the Mideast, and what have you. Honestly, I think if it was as worst case scenario type things, oil would be a lot higher, market would be down a lot more. There's some hedge funds that have people on the ground over there watching what's going on with shipping and such, and those of the rest of us could just watch the oil market and watch the stock market for clues as to what the real geopolitical action is down there. For us, we're playing defense, seasonal defense as well as some tactical. So John will be happy to know we're in the IBB and the XBI, a couple of great sectors doing well for us. We've been in that for a month or so. Just put out another seasonal setup recommendation for gold. I know, Mike, that'll be music to your ears. So the GLD, the GDX, the GDXJ, the ETFs, you'll remember that there's a fourth quarter gold play that's been going on for a million years. It's been in the almanac forever. So not only is it getting into that season, it starts early July, August, but gold's come down quite a bit from the highs. So it sets up tactically, and it's looking like a nice, defensive place to be in. There's a few other sectors we've gotten into recently. Healthcare, staples. We also put out a basket of some real, Campbell Soup and Heinz type of stocks, dividend payers for the, just a little defensive dividend paying action and some utilities. So that's kind of where we're at right now.
Okay. All right, Luke, let me go to you. Again, are you encouraged by what you're seeing in the broad averages where it's not just sort of this Mag 7 world anymore? You're getting more participation, more breadth. Thoughts on small caps outperforming in the first half, and maybe where you see things going now that we're in July?
Jeff's a very smart guy, so I never like going against him. We're actually kind of doing some of the opposite in a lot of ways recently, especially the past few months. And I think it was back in March, we were down in Florida at the Money Show, and I was mentioning how software was huge buy at that point in time, specifically like IGV, I think was trading at $78 a share. That's rallied about probably 20, maybe even 25% since then. I think IGV sits at 94, 95. It got up to 110 at one point. We're pushing in more chips to a lot of these non-mega or mega cap Mag 7 tech stocks, specifically in software. And to me, it feels like I'm surprised the market's not even higher in some ways, because from a fundamental standpoint, I mean, Q2 expectations for earnings is looking to come in about 23%. We'll see if we actually get 23%. We think we will, if not higher. Historically, S&P earnings is, I think, 6% on average. So we're delivering 4 times the earnings growth in the S&P. And then you look at historical multiples, you're looking at forward PEs. We're trading at 21 to 21 times forward PE in the S&P, when historically we trade at 17 times. So you're telling me the market's overvalued by 30%, but we're also delivering 4 times the earnings growth. That's pretty sexy to me in a lot of ways. So I think the market's probably going to trend higher. I expect probably lower volatility the next few months, which is, or not lower volatility, lower volume, because of summertime and seasonality. Probably Jeff can hit on that more. But that being said, lower volume is not necessarily a bad thing. I think that lower volume just means the market slowly inches higher. I think we're seeing a lot of rotation happening in the market the past few months. You've seen a lot of money come out of semiconductors, go into other areas. You've seen the RSP, like you said, equal weight outperform. I think that trend continues. And small caps specifically are very interesting. We've been adding a lot of smaller names, and we own IWM too, specifically the Russell 3000, Russell 2000, because we do think the Federal Reserve is not going to stay true to their interest rate hikes. I mean, you already saw that come down, I think, from 2 hikes to 1 hike when Warsh said that inflation expectations are coming down with oil prices near 70. Oil prices below 80 is a good thing.
Yeah.
If we get back above 80, that could cause issues. We'll see what happens with the Iran situation. But as long as oil stays below 80, we think the Federal Reserve either doesn't hike rates, or they stay the same, or they cut rates, which is going to be really good as a tailwind to small caps. Real quick, dollar index, I think, is topping. It's funny how the market's gone against the grain of the dollar index. With it rallying, I think 6% since year to date, since January. Since it's gone against the grain, if the dollar has topped and we aren't getting rate hikes, we think the dollar's going to come down, which is another tailwind to the whole entire market. So we're pretty bullish. We're the most bullish we've probably been in the past year.
John, yeah, you bring up the dollar. Obviously, that is the expectation of a Fed hike or two, as opposed to cuts, and worries about that driving the dollar up and putting pressure on gold, like Jeff was talking about. But if you're seeing maybe a dollar top and Jeff's looking at some potential action in gold, to play the inverse of that maybe that's something to pay attention to if you're watching this. And if you're watching this, I am going to remind you, this is interactive. We want to hear from you. You do have a chat window on your screen. If you think of something you want to ask these guys, just type it in there. Madison can relay it to me, or I can see it on my screen, and we'll make sure we get that answered. John, I want to go to you because you sent me a fantastic chart of just the breakout, the powerful action we've seen in the biotech world that you kind of swim in. What are you seeing there? What's driving it? And kind of what do you like here?
What we're seeing technically, there's underlying fundamentals are finally catching up. The group had started to gain traction late last year when we were in a clear Fed easing situation. Biotechs in general are trading on discounted earnings, so they can be really interest rate sensitive. So longer, more mid to long term, we really like seeing oil down here. That does give Warsh, looks like, some flexibility. If we can get some of these CPI numbers down, that really helps continue what we've seen as a real rotation into both big pharma and biotech. I think the top is a little more conservative. You're getting some nice dividend plays at the big pharma side. But in the biotech, we're seeing a mini explosion, and we've talked about this off and on for years, of mergers and acquisitions. There's really, big pharma literally just sells. I mean, how many drug commercials do you see on TV every night? I mean, these guys print cash. The problem is they don't have deep pipelines, but that's really not a long-term problem, and that there is a marriage basically between biotech and pharmas. Biotech develops the drugs and the pipelines. Pharma comes in and buys them. We had another 100% premium buyout this week, a $10 billion name, which ends up being small change for the big guys. AbbVie made another big move last week, but probably the most interesting player has been Lilly.
Okay.
Lilly has made more money than God selling GLP-1s. They are the largest pharma in the world, just went over $1 trillion, and they're out there making $5 and $10 billion deals left and right this year. what we really like in our small and mid cap space in biotech is these are stocks that are getting bought at 50 to 100% premiums overnight, but that big pharma is not buying that for that to go down. That's just showing that there's underlying value in the sector and really puts a floor under some of our names.
Got it. And I want to stick with you because obviously you brought up the GLPs. I think from some of the work I've seen of yours, there's some knock on, follow on, whatever you want to call it, Me Too type companies and drugs. They're trying to find ways to profit off that. Is that what you're seeing as well? And outside of sort of the weight loss arena, is there any particular sort of category of drug that's pretty hot here and that some of the companies you follow are getting involved with?
Well, we've seen some of this. The acquisition by AbbVie last week for Apogee was for the allergy inflammation market, which is what we're seeing a lot on different psoriasis, atopic dermatitis, the Dupixent, all of these different drugs you're seeing. A lot of them have to do with these new inflammatory diseases and allergies. So these are huge markets. These are becoming $10+ billion drugs as they can address one market after another. We have a company we would like a lot in this space called Celldex, CLDX, and they have a specific drug that inhibits mast cells. Mast cells are kind of key mediators in almost all inflammatory processes, including things like asthma. So we think there's going to be multiple different drugs treating these types of diseases, but when you can have your best in class, there can be some huge profits made. And we're looking at, truly blockbuster drugs. They're selling $10+ billion.
Got it. Jeff, let me go back to you and, talk a little bit more about your seasonality scenario. Because I know I've read about your Christmas in July, but then if I'm not mistaken, August, September, you get kind of that weakness before maybe a fourth quarter pickup, right? How do you see that playing out this year?
I think it's going to play out. It's the weak spot of the 4-year cycle as well, the midterm year. We got, some of that Q2, Q3 weakness pulled forward by the Iran war into Q1. We had a big rally there at Q2, and I think that sets up for some weakness. I know, Luke, we were talking about the low volume. We call that the summer doldrums, and it's not bad, but it does tend to soften the market a bit, and that's where we think we could have some weakness. But this sets up the sweet spot of the 4-year cycle, the Q4 midterm year through Q2 of the pre-election year. NASDAQ gains about 29% on average there, S&P about 20%, and Dow 19% over that 3-quarter period. So this Christmas in July, the midsummer rally through mid of July, we've seen a lot of peaks in mid-July recently and historically, and that's where we're looking to sort of lighten up on some things, take some profits, pull a few underperformers off the table, get a little set up defensively for that fatter pitch August, September. Technically, there's a couple levels that stick out to me. Generally, where the old October 25, sort of February 26 highs around 24,000 NASDAQ and around 7,000 S&P seems to be, a reasonable pullback area. If things were to get a little unraveled, whether it be in the Middle East or elsewhere, we could see that old ceasefire gap filled, what I call the ceasefire gap, the April 8th gap. I think that's going to be hard to do. I'm not expecting that, but that's sort of a worst case scenario. On inflation, that's one of the aside from the midterm elections, which I think can scare people if things go one way or another market wise. But inflation is also something we're looking at, and I know we're all happy at the pump and with looking at crude oil and everything down, but what happens if inflation proves to be a bit stickier, even with oil down? I mean, we're going to see a couple of prints coming up soon. I think the CPI is next week, and then PCE the end of the month. If we don't see those numbers come down a bit, perhaps it's not just oil. I mean, there's a lot of this spending we're talking about. I mean, CapEx, data centers, hyperscalers and all that stuff, plus the government spending. I know we have a supposed more conservative party in power, but they seem to be spending as wild and crazy as anybody else, as the other side. So we've got government spending and CapEx spending. My sort of back of the envelope economics tells me that spending increases inflation a little bit more sustainably than just the fluctuation of the volatile energy prices.
Got it. I actually have a couple of questions already coming in, but before I jump to them, and I want to give you and Luke a chance to say, in your case, Jeff, maybe your favorite stock or ETF for this defensive period. You threw out a bunch of names earlier, and then maybe what you think you might play for fourth quarter strength.
I mean, I've always been a fan of the biotech. Hat tip to our compatriot over here, John. XBI and IBB are doing well for us. I don't pick the biotech stocks anymore individually. We'll leave that to the pros, on the program with us here. But gold's looking like a decent setup. I try not to pick favorites. I try to move with the seasons and what's going on. Small caps, we've been in that. I own the IWMs. We've got, some of our favorite small caps are up there. Arch Rock, a little energy company, AROC is up pretty solid. StoneX Group, they own Forex.com, and they're, benefiting from the big, trading action out there. They're up. They were up a double. I took a couple of shares off the table on a double there. So fourth quarter, we'll be running a screen for some new stocks. Seeing what comes through. Looking for some more, AI tech stack, super boom type stocks. I don't have anything right this second. I think it's a little bit early to start looking for that. We'll wait for a bit of a pullback.
Fair enough. Luke, anything favorite idea? You threw a couple of sectors and things out there for favorite idea for now, maybe?
My mouth tends to get me in trouble, but I guess in this industry, having conviction is sometimes good. So I'll throw out some highlights of what we've been buying over the past few weeks, what we've added to. So Oracle, I'll bring up first. Oracle is down, I think, 20% probably since its earnings. A completely stellar rock star earnings. The only reason it's down is because people are concerned that they're investing hundreds of billions of dollars investing into AI over the next decade. What just happened a few days ago was Samsung's report. Samsung had a rock star earnings, 1,800% growth in profits, I think 40% revenue growth year over year, something along those lines. But then the stock sold off like 7% because they're investing $650 billion over the next 10 years. To me, when I hear companies are investing into the future of AI, which is here to stay and is going to absolutely add so many dollars to the bottom line, to all of our lives, to every company's bottom line, that's music to my ears. It's like if you were told, should you invest in the internet in 1995 or 1996? Like, absolutely, you should build out infrastructure to put your business online or to start selling online. Like, that should be music to your ears. So Oracle is one of our highest conviction plays. We picked up more shares last week. A new stock we added in the software space, Akami Technologies, AKAM. They're basically, the bellwether for the internet, all your speeds, buffering, the tech issues we had earlier, that stuff Akami kind of solves. They put up servers all around the United States and make sure the internet speed is there. But they should benefit as AI transfers to more inference technology and be able to kind of program itself. That should benefit as well. Two other stocks we picked up recently in the software space, HubSpot. HubSpot's been unfairly beaten down, kind of as Salesforce has been beaten down as well. We picked up HubSpot rather than Salesforce. That just is an unfairly valuationalist play within the software space. That also is one of the best CRMs out there. I use it in my business. My previous business used it. Most people I talk to use HubSpot. Once it's sticky as well, it's almost impossible to leave your CRM. It's very hard to transfer a lot of that data. So once you're a client, you're almost always forever a client. And same thing with Guidewire. Guidewire, I think GWRE is the ticker for that. Guidewire is in the insurance space. A lot of banks and insurance companies are stuck in the 1950s still. I mean, I still can't believe sometimes we use checks and like things don't clear fast. It's crazy to me how stuck in the past we are. But basically AI, the actuarial, I was a nerd my entire life, right? So I wanted to be an actuarial, I think, in college at one point. So, the actuarials, they're calculating all the mathematics behind things. There's no need for actuarials anymore because AI is going to be able to do it probably better and more efficiently to determine what is the property and casualty costs of insuring this and how do the insurance make more money, over time. That's going to be using AI, and Guidewire provides that. So I think the software space is going to continue to rotate money into. You can play it in this ETFs, or you can play it individually in stocks. And obviously we manage a 30 to 35 stock portfolio, so we play in stocks.
Got it. Well, you mentioned Samsung and what's going on there is one of the names, and that sort of segues into one of the questions I've got on my screen. And that was essentially, should we buy SK Hynix? It's listing tomorrow on NASDAQ. Many of you know, biggest ADR listing in history with a 28 billion or something like that. So whoever wants that, I guess probably you, Luke, since you were talking about chips and companies in the AI space.
I'll real quick just summarize my macro view on IPOs. I guess I'll bring in SpaceX here. There's a lot of liquidity in the system. Credit spreads are pretty tight. As Jeff was mentioning, trillions of dollars being spent by our so-called conservative Republican top administration. But all that money slushing around is making that liquidity strong, and there's too much money slushing around. IPOs are going to get extremely high valuations. Once these lockups come about, I think a lot of these IPOs are going to come below probably their price. Of course, it's probably going to open above its IPO, set price. It's probably going to stay there for a few months, but over the next year, I would not be buying most IPOs. Like I said, we're pretty bullish right now over the next, 4 or 5 months. At some point, our biggest concern is employment. I know AI is not technically really replacing jobs yet. It's probably creating new jobs right now in a lot of ways, but AI is truly meant to replace a lot of jobs. So once unemployment takes up, some of that liquidity and borrowing and credit kind of goes down the dumpster. And I think that's my concern heading into 2027. So again, you have to be nimble. I'm not saying I'm bullish forever, but right now for the next few months, especially midterms real quick, heading into midterms, the administration wants the market to go up. You want gas prices to come down, markets go up. That means trying to pump more liquidity in the system, spend more money, put patches and band-aids on top of stuff. And that's kind of why we're bullish over the next few months as well.
Got it. Jeff, another question that somebody asked was, what about SpaceX? So, I mean, since we're on the topic of IPOs and liquidity and so on, any thoughts on either that name specifically or just the trend overall for these big mega deals to hit the market?
I was going to mention SpaceX on top of what Luke was saying there. I mean, I have a bid in, good to cancel order in for SpaceX at 135 at the IPO price. We'll see if I get it. It got kind of close there the other day. Maybe it was 140 something or low 150s, I think I saw. So again, the old saying is like, if you can't get any of an IPO, you want as much as you can get. If you can get as much as you want, you don't want any of it. So I think that's an old Norm Fosbeck quote, if memory serves. But basically, wait for these things to come back down. If you're privileged enough to get a piece of it at the IPO price, you can trade it. But as you can see with SpaceX, it traded back down to the open price recently. And I would suspect that that's going to happen with, SK Hynix, right? And, SpaceX, I'd be patient on. I don't think you bet against Elon or that whole future. I mean, I was watching the World Cup the other day. There was a Starlink ad, SpaceX ad. So it's going to be there, but I think there'll be opportunities, buy things when they're, out of favor, sell when other people are, Warren Buffett, sell when other people are greedy, buy when other people are scared. I think that goes pretty much for IPOs as well. I think it'll be time to get in there.
Yeah, fair enough. John, I don't have a question about a biotech, but I'm going to ask you about one of those that you and I were kind of talking about off camera ahead of time, and that was PGEN. Can you lay out what that company does? What's attractive about that in your space?
It's a really clean, I'm going to call it a rifle shot. There was a really interesting gene therapy technology play, but they've got their one drug most recently approved. It's for a respiratory disease that requires scores and scores, up to 10 surgeries a year to remove polyps and growths. This is now a gene therapy, and they're showing they're able to prevent surgeries and have an incredible change of quality of life. So it's a rare disease. These things sometimes are less than 50,000 patients, but they can be extremely profitable. But we really like the execution, and they're having a strong launch. But I want to get back to the SpaceX for a quick second.
Sure.
And then I always get what's AI going to do for drug development? We're not sure, because you can't change the drug development cycle much. Discovery is great and all, but once you start, it's a 5-10 year process. But space offers a very, very unique opportunity to put a real first-class lab. Space Lab is like a 1973 high school biology lab. This is going to be the AI is going to be there. They're going to have biotech labs in space. But If nothing else, they're going to be able to create brand new intellectual property after the different way the molecules are going to interact in what they're calling a very low gravity environment. This is for materials also. This is where space is tangible, and you get into doing development and discovery in these low gravity environments. You're going to be able to make different crystal structures and things that are just really going to be also, but tangibly have value. So pharmaceuticals in space, there's no public companies yet, but that's something that I have my eyes on very sharply, and I think it could be a very, very interesting space as we are going to be consuming more and more drugs and also potentially manufacturing these drugs in space.
Okay. No, it's great perspective. I mean, it's fascinating when you think about the different use cases and the different ways AI is going to be impacting pretty much every industry on Earth. So I appreciate that. It's amazing this next name that somebody's asking about. I mean, it was something nobody would stop talking about a year or two ago. And surprisingly, I read a Bloomberg story that pointed out that it's now the cheapest since 2019, even though pretty much everybody owns it. It's lost about $1 trillion in market cap. I'm sure you're not surprised here. Somebody's asking, should we buy more Nvidia? So, who wants that one? Not sure.
I can start. I would
Go ahead,
say
Luke.
no. We own Intel specifically, so I'll talk. I guess my book. The reason we bought Intel in a lot of ways was because we thought money would rotate into other semiconductor plays, and thankfully it did. When we bought it at 25, went to 125. I think it's probably 110 now. Also, once the government, this is a general advice, like once the government backs something or buys something, I mean, it's kind of crazy. I never thought as a capitalistic and American society, governments would be taking stakes into companies. That's socialism. But anyway, anytime the government buys a stake in something, you should buy that as well, because they're not only going to pump their own money behind it, push up prices, but they're also going to spend money in that sector and pump that sector up as a whole. So no, I would not buy more Nvidia. A lot of these stocks in general are the cheapest they've been since 2021. I reference software a lot there. Valuations, I think a lot of these stocks are trading at 40 to 50 time multiples in 21. Now they're trading at like 16 or 17 time multiples. The main reason real quick I wouldn't buy Nvidia though is I think the semiconductor play is not necessarily over, but it's towards the later innings. All that money is like Newton's laws of not motion. One of Newton's laws, I think energy is not created nor destroyed. It's kind of how money works. Even though money's created by the government and printed into the system, money's really not created or destroyed in the market. It's just transferred. So I think a lot of the valuation plays are going to transfer, even though it's cheap as it's been since 2019, like you mentioned. A lot of that money, semiconductor money, is going to transfer to other parts of the markets, and that's where I'd focus on more.
Okay. Jeff, anything you kind of smirked a little bit there. Anything you'd add to this one?
I mean, the chart looks kind of attractive on Nvidia. I'm not an Nvidia analyst, but I don't know. It's back down to the October, November highs that I was talking about. I mean, if it's a stock you like, it's better buy here than it was a month or two ago. So, I mean, I don't think they're going away. It's if you had bought Intel back in 1995, you're buying it again here. So, I don't know. It looks attractive on the chart, but coming into the weak season, mid-July rally, probably get a little cheaper. Maybe wait for it to get back to the June lows again. What was it, about under 200, 192 or something like that? I don't know. Look to be a little bargain hunting on this one.
All righty. I'll tell you, seeing Intel, I'm just amazed because we're talking about the 90s. I'm back to like the Wintel thing, that whole trend in the 90s. I mean, it's crazy.
And grunge is in again.
Oh, I can pull out some of my old t-shirts or, flannels. That sounds awesome.
I'm listening to a lot of Soundgarden these days.
Real jam.
Taking me back.
Just
John,
watched Singles the other night.
We got 1 or 2 more minutes, John. I think the other stock, I don't know if you mentioned it earlier on here. I don't think so. It was Viking. And I know I was actually pulling up the chart over here because I know you've written about that for a while. Thoughts on the latest news out of that company?
They're basically up on the M&A in the last couple of weeks, but they're about to put their first trial, where they're calling it a maintenance trial. And they're going to be doing a lot of different things between an oral and a sub-Q formulation of a second generation GLP. So their GLP-1, it will have new intellectual property, but it's the only one out there that has the exact same chemical structure for an oral and a sub-Q. So basically, you start on the sub-Q, titrate off of that, go on to an oral, maybe once a week, once a month. They're trying a lot of different things. And this is what I'm really thinking is the real world of GLP-1s. And also, this is a way to manage around what's severe nausea and some of the side effects of these drugs. It's going to broaden the class, but also to seamlessly switch between oral and sub-Q could be a major market advantage, and also is something the FDA will be very comfortable with because the side effect profiles are all of those of the being the same chemical structure. So I think they're right in the crosshairs. Novo Nordisk has got a new CEO. They're really trying to keep up with Lilly. Even though Lilly could make the move, but obesity is not going away because it treats so many other comorbidities. I mean, sleep apnea is now approved for it. We're seeing really good, obviously, in diabetes. But so the longer term benefits of losing weight are really positive long term for all of us as a society. And it's just more drugs make for happier people.
Got it. All right. But that's a great way to wrap it up. More drugs make for happier people. Listen, I want to thank everyone who's watching. Thank you, Luke, John, and Jeff for joining me. If you guys aren't aware, we do have the Money Show Master Symposium Las Vegas. That's right around the corner. It's July 19th to 22nd at Caesars Palace. Mr. Hirsch will be joining us there, so we're excited about that. If you haven't checked it out, LasVegasMMS.com, or you can just go to moneyshow.com and look at the live events drop down. And then John is actually going to be joining us for the San Francisco event. We're back in the heart of San Francisco, not Burlingame again, back in the heart of San Francisco for the first time since before the pandemic. We're going to be at the Fairmont on Nob Hill. If you know San Francisco, it's a beautiful location. It's a beautiful property. Yeah, it's going to be a great time. So love to see you come out and join John there to get his best ideas. That's August 25th to 28th. Luke, I'm not sure the next one we got you at, but it might be a little while here.
I've been running around with a chicken with my head cut off, so just give me a call. We can talk about it.
There you go. Sounds great. But we've got you virtual. We'd like to see that. Again, thank you so much, everybody, for joining us. Hope you enjoyed this session. Hope you enjoyed the expo. And look at your calendar. See if you want to meet us in Vegas or San Francisco soon. Gentlemen, have a great day.
Thanks, Mike. Thanks, guys.
Thank you, Mike.
Thanks.
Good seeing John, Jeff.
Take care, guys.